So, is that mic working? Can you all hear me? Morning, everyone. So this is the opening plenary session of this year's RES conference. And the title is, What Should Macroprudential Policy Do in a Bust? That's, I think, a good question. I said that partly because it's my question. But partly because it is an of-the-moment question. So we are in a bust. This is a slow, low recovery, the slowest and lowest for several generations, actually. And in countering that bust, we have a new instrument lurking around, which is this thing called Macroprudential Policy, which you'll hear a lot more about in the next hour and a half. And the question is, how best should we put this new tool to work in countering the effects of the bust? So let me just outline very briefly the running order. We're fortunate to have three absolutely fantastic speakers on the topic, who I'll introduce very briefly now. They'll each have about 15 minutes. So speaking first will be Martin Wolf, Chief Economics Commentator for the Financial Times. Speaking second, we will have Helene Rey, Professor of Economics at the London Business School. And third, we'll have Franklin Allen, who's Professor of Finance and Economics at the Wharton School at the University of Pennsylvania. They'll each have 15 minutes, roughly speaking. Then we'll open it up to the audience for a Q and a mashup discussion of the topic. But just perhaps a couple of points from me as framing for the question for this session. What is clear, I hope, is that the circumstances prevailing today are those in which we would expect macroprudential policy to do some work. Why do I say that? I say that because, for me at least, macroprudential policy is pretty easy to define. It is regulation with an eye to the real economy. That is what differentiates it from microprudential, where the focus is instead on the fortunes of individual financial firms. And what I think we'd expect macroprudential policy to be doing is to act in an overtly countercyclical fashion, which is to say curbing the booms by tightening regulation and cushioning the busts by releasing those buffers that have been built up in the boom period. Sounds pretty obvious, but in fact has been countercultural to the vast majority of prudential regulation for the last several decades. In the teeth of a bust, the regulatory inclination historically has not been to loosen, it has instead been to tighten. That when we're in a recession, risks are big. This is not a time to be taking chances with the fortunes of individual firms. Macroprudential regulation is meant to turn that logic, to turn that intuition on its head, and to argue that in situations like these, if we ask each individual firm to remain tough, then the consequence will be tougher aggregate credit conditions, a weaker economy, and ultimately a weaker system. So in a bust, macroprudential regulation suffers from a fallacy of composition, and the role of macroprudential policy is to lean against that fallacy. Now, there are at least a couple of reasons why there's healthy skepticism about whether even macroprudential policy is up to the task of acting countercyclically. So one line of argument would be that it is ineffective. It's effectively pushing on a string, as might be many of the other arms of macroeconomic policy right now. A second line of argument heard frequently by the media and politicians and lots of banks is that regulators are genetically incapable of acting countercyclically. They're incapable of loosening in the teeth of a recession. But I think both of those arguments are overplayed, and that, for me at least, macroprudential policy can and should have a role in situations like this in cushioning the real economy. And I say that partly by reference to experience here in the UK over the last couple of years with our new Financial Policy Committee housed in the Bank of England, which is explicitly charged with conducting macroprudential policy. Now, I'll mention very briefly two things that this FPC has done, which I consider to have been overtly countercyclical, that have been macroprudential policy playing its role in cushioning the bust. The first came in the middle of last year when the bank launched a four-pronged package of measures to support the banking system and, in turn, the real economy. And the four prongs were meant to support bank funding, bank lending, bank liquidity, and bank capital. So on the funding side, we extended term liquidity. On the lending side, we launched a funding for lending scheme. On the liquidity side, we loosened, banks' liquidity requirements to encourage them to lend. And on the capital side, we levied a zero capital charge on any lending to support the funding for lending scheme. Four measures, a collective package, although we didn't actually present it in that way, unfortunately, a collective package aimed at loosening regulation, stimulating funding and lending, an overtly macroprudential package. The second example I thought I'd give, FPC example, is one from last week, where we, as FPC, asked the banks to top up their capital resources, to fill a capital shortfall of as much as 25 billion. Contrary to what some have said, and to what some of you may have read, that was a macroprudential action which aimed overtly to try and strengthen balance sheets, support lending, and thereby support the real economy. Why do I say that? I say that because it's a stylized fact that bust banks, certainly capital-constrained banks, do not do lending. And you need only look at the lending patterns of the UK's biggest banks today to see that those that are most capital constrained are those that are doing the least lending right now. So the FPC's recommendation as recently as last week, which some had taken to be a regulatory tightening, was overtly with a view to stimulating lending and spending, and therefore having macroprudential policy serve its rightful role in acting counter-cyclically. Now, I would say that, wouldn't I, as I work for the Bank of England. Those views might not be held by our speakers this morning. We're about to find out. And first up, we have Martin Wolf. Martin.
So first of all, it's a pleasure and an honor to be here. I was reminding Andy that the last time I addressed a session, and I think this is the annual meeting of the Royal Economic Society, was I think in 1998 or 1999 on the Asian financial crisis and its consequences. So what I seem to be fated, in other words, to discuss financial messes, and we don't seem to learn from them. That is the main conclusion I reach from the fact that I'm back here discussing the same sort of issues in a different context. I am, of course, not an academic, and I'm sure that's why I was asked to go first, so that the intellectual tone should be raised steadily during the, from here on towards the level that you expect. In other words, my job is to provide light entertainment. Okay, I have chosen, I think this follows very well from Andy's remarks, the title of, I've abbreviated, The Difficulty of Closing Stable Doors. Clearly, all the horses fled. We ended up with an essentially bust, an incredibly distressed financial system. To the extent it wasn't bust, it ceased to function on almost all dimensions, and the government has given the Bank of England now, and particularly the Financial Policy Committee, the job of doing something about this. And the dilemmas are, I think, very profound, and that is the main theme. I think I will introduce at least the problems, and I do hope that the succeeding two speakers will explain how they're all going to be solved. So I'm going to cover 4 topics. First, what I think the role of macroprudential policy is, which is very closely related to what Andy says, but since I'm a journalist, is put, I think, a little more sharply and indicates that there are really quite deep conflicts in it. Then I'm going to talk about what it would have been like to run macroprudential policy if we were in an ideal world, and how simple it would then be, because most of these conflicts wouldn't exist. In fact, the core conflicts wouldn't exist, and indeed, Andy's discussed that already when saying in an ideal world what we're trying to do is countercyclical policy. Unfortunately, we're in the bust, and there sure wasn't any countercyclical policy in the boom. So we have a problem of starting from where we are. And that leads me to the problems of doing macroprudential policy in the real world, and that has 2 dimensions. The sort of permanent condition of trying to do macroprudential policy countercyclically, even if we roughly knew what we were trying to do, which we surely didn't before we got into the crisis, and the actual problem of doing it now. And that leads me to my 4th section, which is what we do now, namely making the best of a bad job. And I think Andy has discussed some aspects of this, and I'll discuss 1 or 2 others, but I'm sure others will go further into that particular issue because I won't have much time. So what is macroprudential policy for? I see it as having 2 closely related, but except in ideal circumstances, potentially conflicting goals. The first is to make sure that the financial system can survive whatever the economy throws at it. That even if we have large shocks, and I'm not going to go into all the possible shocks, we are reasonably confident that we will have a financial system at the end of it, or that we have a financial system we can rescue if we actually really had to. And the second goal is to protect the economy from the financial system, since the financial system has tremendous capacity all in its own to make a mess of things, and it can, in the process, mess up the economy in a very big way. Obviously, this is the reason I put this in this way is because the financial system is A, big enough, and B, integral enough to the economy that all the effects are two-way. And that's really very, very important in considering what macroprudential policy is designed to achieve. So I see it as ways of doing monetary policy, as it were, without just focusing on classical instruments, and at the same time protecting the financial system from what's going on in the economy. The former, of course, the former activity to protect the financial system from the economy can be seen as supervision of and regulation of the financial system as a whole, as a system, as opposed to regulating and supervising individual institutions. But the latter, of course, the latter activities border very closely on monetary policy, but it tends to be somewhat more targeted. For instance, sector-specific equity requirements or sector-specific loan-to-value ratios. You could have imagined that in the pre-crisis period, that if the Bank of England had those tools, instead of, say, raising interest rates to cool the economy, it might have decided just to target things that were going on in the housing sector. I'm not saying it would have, but those are substitutes for monetary policy action. And you can even imagine, and this is crucial, sorry, can we go back? You can imagine that they would actually conflict if you use these two instruments. Now, the uncertainty about what uncertainty is perhaps the wrong word. The complexity of what macroprudential policy is about or for affects the considerations that should be brought to bear in doing it and who should be responsible for running it. And this is particularly important for that aspect of macroprudential policy which concerns the impact on the economy. And I feel that there's going to be a very big problem in the long term, potentially very big problem, because a lot of what the Financial Policy Committee will be doing, or any macroprudential regulator will be doing, will affect quite fundamentally what the Monetary Policy Committee will be trying to do. You could imagine a situation in which, from a macro point of view, the Monetary Policy Committee will want to loosen, and from a macroprudential point of view, the Financial Policy Committee will be trying to tighten the activity in the financial sector. So these things relate very, very closely. That wouldn't be true in ideal circumstances, as I'll come to that in a moment. No conflict between the two possible goals of macroprudential policy should normally arise. But in the real world, they do or can conflict, I think, big time. And I'll come to that towards the end of my remarks. But the crucial point I want to make is I think this is a very complicated activity. It borders on supervision and regulation of institutions on the one hand and macro policy on the other, and managing in a way that fits naturally with the activities those responsible for supervision and regulation on the one hand. Remember, we only have 5 banks. So it's inevitable, therefore, that the supervision and regulation of banks, Lloyds has 28% of personal current accounts. Anything you do for Lloyds will have macro implications. So that relates to the supervision regulation side of the macroprudential authority. And then, of course, there's the monetary policy side, which is pretty clear, and I've already indicated. So in an ideal world, if we've done this properly, banks would have quote-unquote adequate capital in virtually all states of the world. I'm not suggesting they should survive absolutely everything. For instance, an asteroid strike may be beyond what we expect the capital adequacy of the banks to survive, but then who cares in that circumstance? If we had that sort of situation, we would raise capital requirements or increase provisioning in a boom, and we would let them fall quite sharply during a bust, and we could do so very comfortably. We will be running a nice countercyclical sort of macroprudential policy. We could allow full provisioning against and recognition of losses in bad times, say now, while ensuring adequate functioning of the financial system, because there will be so much capital cushion, possibly also liquidity cushions, I don't have the time to go that, to manage, so there wouldn't be a problem. And we would have had the right degree of prudence built into lending practices, loan-to-value ratios, and so forth. So everything could work countercyclically very, very beautifully. Unfortunately, we don't live in such an ideal world for at least 3 reasons that apply at all times. The first is we really don't have a consensus. There are genuine differences of informed opinion on how much capital banks should normally have, how liquid their assets should be, how cautiously they should lend in a boom. So all that sort of semi-automatic stuff is going to be pretty controversial in those areas. Second, very important, and this applies at all time, there are very powerful economic and political interests that will act against prudence, particularly in good times. They're certainly going to argue, okay, you've got far too much capital now. Why are you bothering so much? Why are you worried about loan-to-value ratios? You're just preventing people from buying houses and making it even more expensive because they're going to have to buy even later. So there's going to be very powerful political interests acting against your macroprudential policy in good times. And third, of course, there is genuine uncertainty about how far the current state of the economy is sustainable, and again, particularly in good times. And I'm reminded of all the debates we had before the crisis about whether what was going on was sustainable or not. So I think even in ideal, even if we look at it, this is a long-run proposition, it's going to be very difficult to make macroprudential policy work. And at the very least, and I think this fits very well with Andy's views of these matters, it needs to be rule-based and predictable. Now, in the real world, my own personal view is that banks should, and John Kay discusses this in his column this morning, have at least 3 times as much equity relative to assets as they do, possibly 5 to 10 times. I suspect others will disagree with this strongly. My view is that risk weighting of assets is virtually useless, so it should be real capital. In other words, the whole structure of thinking about capital for banks is pretty well completely useless. So that gets quite a long way from the ideal world. Furthermore, capital requirements must be particularly high for countries that have very large and very concentrated banking sectors, such as the UK, since a failure is likely to be hugely costly in such circumstance. And of course, none of this is agreed, so the benchmark from which macroprudential policy will work isn't agreed. I just thought I'd put this in it's my favorite chart on banking. It came from the report of the Independent Commission on Banking. I was a member of the commission, and what it shows the genius of risk weighting of assets. It shows that from the year 2004 to 2008, and we all know what happened in 2008, the banks and their regulators obviously decided that the riskiness of banks' assets was collapsing. That's the red line, and once upon a time there were risky assets, and by 2008 there was essentially no risk in the banking system at all. And as a result of that, they were allowed to leverage up from about 16 times to about 33 times over those 4 years. So much for the risk weighting of assets on which all the macroprudential rules fundamentally rest. But beyond these fundamental questions about how we do this in the long run and the huge political and economic pressures and uncertainties surrounding it, we have a very specific real-world problem now. And that's where I'm going to conclude. In other words, as in the famous Irish joke, it really would have been much better not to start from here. And I think Andy brought out some of the problems here. The banking sector, and I think everybody would agree with this, did not go into the crisis in the UK or really anyone else with anything close to reasonable levels of capital or liquidity. I'd just like to remind you of this chart that went into it with staggering levels of leverage and virtually no equity whatsoever. And that creates a head-on clash on what is needed post-crisis. Because if you look at the financial system as a financial system, the general demand is, and it's only a matter of discussion how much, that we should be moving forward to higher capital and a generally more prudent standard of lending and financial activities than we had before the crisis. But of course, the economy is in the doldrums, as Andy brought out, and everybody knows we're in the longest recessionary period for at least a century. So we want more risk-taking and more lending. This creates really quite a big problem for macroprudential policy, which is the core of where we are now. So how does one sail to an uncertain destination after a shipwreck in vessels, by the way, which were full of holes even before we had our shipwreck? I would suggest the following answers. In the long run, the goal of having a more robust financial system able to cope with big changes in market conditions is indeed of huge importance. The goal should be clear. That's where we want to end up with, something much more robust than what we went into the crisis is. I think it's less important how fast one gets there, and it's particularly true now because probably excessive risk-taking is not now the danger, though of course there is always the risk that some institutions will decide, since they don't really have any capital, why not go for broke? But banks may also still need to write down a great deal more bad debt, particularly if house prices fall further, and that's another reason for them to need to be fairly robust now. And for these reasons, and I think Andy's just touched on this, we do need a minimum level of safe capital in the system already, and we can't really go far below that, and we don't have much capital in it today. So I suggest this can be done, moving in that direction, either by government underwriting of rights issues, so the government actually does generate the capital initially, or by simply stopping dividend and bonus payments until the adequate levels are reached. And in this way, capital could be built up, the second way, over a longer period. Lending on ultra-high loan-to-value ratios has become a bit safer with the house price correction, but it is still risky. It's not clear how much we should be encouraging it. So I conclude that if governments want to subsidize such risky lending, it should do so in ways that encourage what is probably the most desirable form of additional lending, that to small and medium enterprises. My conclusions: there is a big tension between wanting to sustain bank balance sheets and accepting that deleveraging of the economy is necessary and desirable. So that's we really want prudence. We want prudence on the one hand, but on the other hand, we also want more economic activity. This is just one of the ways in which we really have done better not to start from where we are, namely with a gigantic banking system, a highly leveraged economy, highly indebted households, huge fiscal deficits, and soaring public debt. This is really not where we want to start from. It's where we are. We want the banking system to be bigger and smaller, safer, and more risk-taking. These are the pressures on the Financial Policy Committee. Good luck with that. Thank you very much.
Thank you, Martin. Hugely entertaining. Not light, quite heavy, actually. Second speaker is Helene Rey.
Thanks very much. It's a great honor and pleasure to be here. I'm afraid I'm going to agree quite a bit with Martin, with maybe some nuances towards the end. So first of all, on what macroprudential policies really should be doing, well, here we agree on the philosophy of the whole thing. We are both trying to protect the real economy from the banks and the banks from the real economy. And in order to do so, I think the key philosophy of these policies is really to build the resilience, if we can, during the upswing, which we have failed noticeably to do, and in order to increase the loss-absorbing capacity and to help the banks maintain credit supply in the downturn instead of going for heavy deleveraging. So this is really the philosophy of macroprudential policies as I see it, and as was mentioned by Martin, we noticeably failed on the upswing to put this policy into place. So now we are dealing with the bust. So let me first say that a lot of my thinking actually on macroprudential policies has been quite influenced by some work that Yun Shin of Princeton and Tobias Adrian at the Fed have been doing. And in particular, they have been bringing to the fore very important stylized facts for many banks. They were working mainly with US banks. And here I'm showing you a cross-sectional panel of European banks as well as some US banks. So it's a very it's a stylized fact that is held very widely in a large cross-section of banks. And this stylized fact is about procyclical leverage. So what are those graphs? Well, they show you on the horizontal axis what you have is leverage. And on the vertical axis what you have is asset growth. So it's asset growth, leverage growth. And you see that these red lines that are all in there, they are the 45-degree line. So what does it tell us? Well, it tells us there is a very strong positive correlation between asset growth and leverage growth. So what does it mean? Well, it means that when there are good times, let's say we are riding a bubble, we are in the 2003-2007 period, so the value of asset is growing quickly, well, so is the value of leverage. In other words, the equity of banks is very sticky, and what is increasing in boom times is leverage. Conversely, in contractionary time, in busts, we have deleveraging. So this is a very, very highly procyclical balance sheet of banks that we are seeing here, evidenced in a very big cross-section. I could have put some more, but there was just no room. So this is the first very important stylized fact. And if you think that it's, not the biggest bank that do that, you would be wrong, because if you look at these procyclicality of leverage for the CFIs, which are the systematically important financial institution, well, you would find really a similar picture. So again, quarterly asset growth on the vertical axis and quarterly leverage growth on the horizontal axis, you see this very strong positive correlation. So we are talking about the big players, the systematically important banks, being also very highly procyclical in their behavior. This is a big deal. Now, why is it a big deal? Because obviously, if there is a lot of procyclicality, well, when the bust comes, when the asset price starts going down, that means there's going to be a whole lot of people who are going to be correlated downwards together, who are going to have to deleverage together, and that's going to create a lot of nasty, vicious spirals, such as we know, asset sales, so the so-called pecuniary externalities that we have in our economic models. Everybody sells at the same time, the price of asset goes down, this makes banks deleverage even more, and so on. So we are in a vicious circle. Now what I have here is, again, the characterization of the behavior of banks. And again, it's a very broad sample cross-section of banks, Europeans as well as American banks. So on the horizontal axis, we have the betas of banks pre-crisis. So this is during the period up to 2007 Q4. So the beta of banks with the world risk. So this is how much they are sensitive to world risk, how much they load on world risk. And on the vertical axis, you have the average return. And so what you see is that in the pre-crisis sample, so the banks who load a lot on the world risk, who load on the systemic risk component, who are riding the bubble effectively, have a higher expected return on average. This is a positive correlation between the beta and the return. And in the post-crisis sample, so this is after 2007 Q4, well, the people who loaded most on the systemic risk factor, on the world risk, are also the people who fall the hardest. This is the negative correlation. This is on a broad sample of banks. If you look at the big banks, it's even clearer. So the big banks are loading a lot in the pre-crisis sample on the world risk, the systemic risk, and the harder they fall when the crisis sets in after 2007 Q4. Okay, so in such a world where we have a lot of procyclicality, a lot of correlated positions in the financial sector, especially from the big bank, so it's no surprise that when we are in a bust time, having failed to actually construct a capital buffer big enough during the boom time, then we are in trouble. We have an aggregate capital shortfall, and we have a lot of banks that can fail. So this is the consequence of this extreme procyclicality in lending and this extreme correlation and this aggregate loading on the systemic risk factor. So as Bob Jenkins, who was formerly on the Financial Policy Committee, puts it, the returns and coincidentally the bonuses may come short-term, but the risks come later, and later came recently. So this is exactly what we have seen with these two graphs. We load up on the risk, we get the return and the bonuses, but then the bottom panel, the risk come, and it actually came not too long ago. So that's where we are right now. So how do we think about, therefore, macroprudential now that we are in this situation? Well, so let's go from basic, here, let's say, economic reasoning. So the narrative I'm going to use here is explained and modeled in a lot more detail in a paper by a colleague of mine, Frédéric Malherbe, called from London Business School, called Dynamic Macroprudential Regulation. But let me explain in 2 words. So assume we are in a world in which regulatory ratios are binding and banking capital is scarce. No doubt it is the world we live in. Okay, so these are sensible assumptions. Now, imagine that banking capital would exogenously double in level. Then it would be optimal to let the financial sector to expand, again in level. So definitely, if the capital, the equity doubles in level, then you would want to expand lending. Now, if the ratios do not change, the banking sector will double lending in level again. But if we're in a world of decreasing marginal return to lending, which is probably the good assumption, then you don't want actually to double lending. This is far too much. So what you want to do, if there is a decreasing marginal return to lending, for example, because of decreasing marginal product of capital on the real side, what you want to do is to increase the regulatory ratio. That comes straight from the decreasing marginal returns. So this is a very simple consequence. Conversely, if the banking capital exogenously was to halve, again, you would get a proportional contraction, a credit crunch. And this time, because the decreasing marginal returns would work in reverse, the marginal return to lending would be high, and therefore, in such a world, what you would want to do, the regulator would have to accommodate to soften the crunch. And some contraction would be optimal, but you might want, indeed, in that case, to decrease the ratios. Now, what is key is that what this very simple view of the world tells you is that all other things equal, more aggregate capital is good up to a certain point in general. Most definitely, it's good in a bust because we need a lot of absorbing capacity, which this time around we don't have. And via the reasoning I just put forward, optimal capital requirements in ratios are increasing in aggregate bank capital. This is just due to the decreasing marginal returns to lending. So what are the implications of that? You see that it is very crucial to make a distinction between increasing capital in level, that is to say increasing the amount of equity, versus focusing on the ratios, the regulatory ratios, which are equity with respect to risk-weighted assets. And what you want to do, so in a bust, if you cannot force recapitalization, then yes, like Martin said, it is better to be softer during the bust. That is to say, decrease the ratio. But if you can force recapitalization, then it is definitely preferable to do it rather than to decrease the required ratios. So in other words, you have to focus on the level of capital and increase the level rather than decrease the required ratios. Even better, what you should do, if you can, is to force aggressive recapitalization, so much so that you can also go towards increasing the ratios. If you have enough capital, then again, via this decreasing marginal return law, what would be optimal would be then to increase the regulatory ratios. So you see here the argument has to do really with focusing on the level of capital rather than regulatory ratios. And during the bust, what you want to do is increase the level of capital. Now, there are lots of people Martin will, again, as mentioned, very powerful lobbies, interest groups, etc., who will argue that a certain approach of forced recapitalization, of large increase in equity capital is impossible, is very costly, etc., etc., etc. And a lot of the arguments against this type of approach has been debunked in an excellent recent book by Anna Tadmati and Martin Helvig, which I recommend to you. Now, the last thing I would like to discuss is a bit different. All right, so capital in a bust, that's very important. On the other hand, I think the fact that we are in a bust should also not make us forget that we have to improve our radar screens. We have noticeably failed to pick up the buildup of risks in the economy for quite a few years. And we need to be able to find more robust early warning indicators or more robust variables or things we can look at which give us some idea about where the next financial risk may come from. The fact that we're in a bust doesn't mean that there may not be some more tensions building up somewhere in the financial system, but of course we don't know where. We never know where. So one interesting approach to trying to detect the early buildup of systemic risk, an approach that I've been working on, is to do something very simple, is to try to have a much more granular, much more precise cartography of risk returns in various segments of the financial system. So you may say, OK, risk and returns, we all know, if there's a high return, then there should be a risk somewhere. This is a very basic economic idea. And that's absolutely this type of idea on which I'm proposing to build. If we see a lot of return somewhere, it means there must be some risk. Now, the interesting thing is that when we look at banking activities or financial sector activity, it's usually actually very hard to put together data at a granular level where we can actually match returns and risk. This is so because the macroprudential or the prudential reportings and the accounting reporting and the way the banks internally report actually usually do not make the profits of a desk, the profits of some investment activities, they do not match them with the regulatory capital which actually apply to this type of activities. There is a mismatch between the prudential reporting and the accounting reporting or the internal reporting of banks. So simply having a relatively fine cartography of risk and return by trading activities or by desk and seeing how these risk and return activities may correlate across firms is, I think, a very intuitive and appealing way of trying to have early warning indicators, trying to pinpoint where the next systemic risk may be building up. Imagine you see a lot of trading activities which turn up high returns, and the regulatory capital affected to this type of trading activity is very low. Well, that's strange. You should at least look into that. And if you see a vast segment of the markets doing the same type of trading activities, which fall in this category, then that should really raise a flag. And this could be one way of, whether in a bust or a boom, looking at early warnings for systemic risk. Thank you.
Thank you, Helene. I forgot to mention at the beginning, actually, that for those of you who missed it, Jennifer Ryan from Bloomberg, an excellent piece on Helene last week, which we're going to look at, called Proving Greenspan Wrong, which is fairly easy these days, actually. Even Greenspan doesn't believe Greenspan these days. But it's definitely worth digging out, which is a great piece on Helene and her important work. Our third speaker is Franklin Allen.
So I'd like to thank the organizers for inviting me to this very interesting session. Now, during the Second World War, Japanese GDP peaked in 1943. By 1945, it had fallen by a half. Now, of course, the Americans dropped 2 atomic bombs, one in Hiroshima and one in Nagasaki. But that was just one set of damage that they did. They used Guam as a base for heavy bombers, and they basically went and destroyed the industrial structure and the infrastructure of the economy. So by the end of 1945, the Allies had won, but the Japanese economy was in shambles. Now, it started to grow. It had lots of problems. There was a hyperinflation in 1946, but it kept on growing, and by 1953, it had doubled from its post-war, or from the end of the war low. It was back to its peak. So growth can occur in very difficult circumstances. Now, as Andy was saying earlier, and has been stressed a lot already, what's amazing about the current crisis is that there isn't much growth. So in the UK, you're still below the peak. Now, it depends how you measure it. We're 6 years from the start of the crisis almost. From the trough, we're probably 4 years. But it's quite possible that even 8 years after the trough, we still won't be back to where we were in the UK before the crisis. And so this leads to this conundrum that we have at the moment. And I think it was well put last August at the conference that the Federal Reserve has at Jackson Hole. And Don Cohn, who was Alan Greenspan's right-hand person for most of the time, he was chairman, and then he was vice chairman at the start of Ben Bernanke's chairmanship. He pointed out that in the US, we have incredibly accommodative monetary policy, very low interest rates, quantitative easing. We also have very stimulative fiscal policy. We've been running big deficits for a long time. And the economy, as he described it, should be going go, 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 but it isn't. It's just going along the bottom at slow rates of growth, 1.5%, 2%. So this is the big dilemma. Why is it that growth is so slow? Now, if you read the Financial Times, you get a number of different takes. So Martin often argues it's austerity. Chris Giles blames the collapse of trade in the Eurozone. Wolfgang Munchau, if you look at his columns on the Eurozone, he blames austerity too. Paul Krugman in the New York Times blames austerity. And I have no doubt that austerity is a big problem and is a contributor in these cases to the slow growth, as is the collapse in trade with the Eurozone. But I think it's important to take a wider view, and this is why Japan is again so interesting. So after the war, Japan had this big surge of growth. They got back quickly to where they were, and it kept on going, and it kept going till their financial crisis at the end of the 1980s. And then it went from being the fastest growing big economy to the slowest growing big economy. Now, I spent a lot of time going to Japan in the late 90s and early 2000s, and they had tremendous fiscal stimulus. So if you go most places in Japan, they have these wonderful bridges linking the islands. There are no cars on them, but they're great bridges. And there's some statistic like something like 70 or 80% of the Japanese coastline is covered in concrete. And that comes from these public works. And of course, they then had low interest rates. And so they had all of these things. And they even had, growth in China and all of the good effects that had, and that they still were very slow growing. So the problem is, why after these financial crises do we have such slow growth? And I think that that's the real issue that we face, and that's the backdrop to which macroprudential policy is faced. And I think my own view is that the fundamental problem is that the financial system breaks down in the sense it stops doing its job. Now, when I say financial system, I think you have to interpret that quite broadly. So far we've focused a lot in the discussion on banks. But it's important to remember that banks are just one part of how firms fund themselves. So a much more important part in most countries is internal finance. And then, of course, in a number of economies, bond markets are also very important. Now, in the short run, I think these kinds of funding problems that people have been stressing are important. But we're now in the 6th year since the crisis started, and you would think that internal finance and some of these other substitutes should be stepping in and filling the gaps with what the banks are doing, because there are lots of ways to finance. And that's why the Japanese example and many other examples of fast growth are interesting, because they occur in many different ways. So, if we look at bank lending to SMEs, there's the usual problem. Is it a supply problem or a demand problem? And that's always very difficult to figure out. If the firms demanding credit are really creditworthy, then you would think that someone would finance them, or they would be able to use their own funds to finance. So let me speculate a little bit about what the main systemic risks today are about, and what should macro policy be doing, macroprudential policy be doing to counter them, and then perhaps we can get some insights. I think probably the biggest systemic risk that we face at the moment is a sharp rise in interest rates. And I'll use the example of Japan again. So Prime Minister Abe has come in, and he wants to try to stimulate the economy again, and he wants to raise inflation to 2%. Now, if we look at that from a macroprudential side, what's the effect of that going to be? Well, let's suppose that they're successful at the Bank of Japan, and inflation increases to 2%. What's that going to do to interest rates on 10-year JGBs? Well, probably they're going to go to 3 to 4%. Now, that's going to cause a huge financial stability problem, because the Japanese banks are loaded up with Japanese government debt. And this is not credit risk, this is just interest rate risk. Now, of course, if they do go to 3 to 4%, then there is a credit risk as well, because Japan has massive amounts of debt. You can quote the gross debt, which is about 220, 230, or you can use the net debt, which is about 135. At the moment, it's not a problem, because at 60 to 80 to 100 basis points, it's no problem to fund that. But if we get to 3 or 4%, it's a big problem, particularly because a lot of the gross debt is going to be paying those high rates, and it's not going to be balanced by the assets they have, because one big asset is what the Bank of Japan holds in foreign exchange reserves, and those aren't hedged. They're going to still be paying low rates. So this is an example of how the central bank and the government are causing macroprudential problems. And my own view is that this is a big part of the problem, and it may well happen in a number of other economies. And I think, if you go back to the boom phase, I think central banks need to take a position on why exactly did we have this boom in house prices? What extent did low interest rates pay in that? What exactly was the government's role and the central bank's role? And I think that this is really where the macroprudential after a bust should be worried, because a lot of the policies that are pursued are designed to try and change prices in the financial system. Think about quantitative easing. If a central bank has a third of the government debt on its balance sheet, what signals, what information can you deduce from the long-term yields on those bonds? They're in effect setting prices and distorting the market. And my own view of why we have such slow growth and why Japan had so many problems is that the financial system stops giving price signals that people believe in anymore. So when I go to Japan and I talk to friends there that explain how they bought a house in 1993 and it's now worth a third of what they paid for it. And of course, if you bought stocks, they're also worth about a third of what you paid for them at the peak. And it's that mistrust of financial prices that, in my view, is the real problem. It's not so much that banks won't lend and so on, it's that people stop trusting the financial system, and that means that they're very unwilling to take risks. Now, a good example of that at the moment is, if you look at the stock markets, it looks as though we're just about to enter a golden age. You know, the S&P just hit an all-time high. Many stock markets are doing really well. On the other hand, if you look at the real economy and you look at growth rates, they're terrible. So you look in the Eurozone, we keep getting more and more bad news, and it seems as though we are even shrinking faster now than we were, so we haven't even hit the bottom in terms of the shrinking. And then even in the US, where things are supposedly going okay, we had a small, albeit small, but we had essentially a small or zero growth the last quarter. And now, of course, we've got some tightening and some austerity. So I think people have stopped trusting financial prices. And I think that that's the real role of macroprudential, should be to get the financial system working in such a way that people believe that when they see prices, those are somewhat meaningful. And I think that's what's gone wrong. And I think we have to be more willing to see things go down and then grow out. And I'll quote the example of the US at the end of the 19th century and the beginning of the 20th century. So in 1870, the UK had the highest GDP per capita in the world. Now, the Bank of England discovered how to avoid crises, and we didn't have a financial crisis, a true financial crisis in the UK until 2007 with Northern Rock. Now, in the US, they had no central bank at that time. They had lots of financial crises, and things would collapse, but they would then grow. And during that period, the US acquired this lead and became much richer than the European countries. And it's held that lead ever since. And it was a disruptive time, but the market signals led people to make good investment decisions, and in the long term allowed substantial growth. And I think in the short term, when you're in the height of the crisis and we have the systemic risk problems of contagion and banks collapsing and asset fire sales and all those kinds of problems, it's valid for central banks and governments to step in. But I think after several years, or maybe after a year or two, it probably doesn't make sense for the government to be so heavily involved. They need to let markets work and for prices to start being meaningful again. And so the macroprudential side, I think the biggest macroprudential policies actually in central banks today are with the colleagues across the hall in the monetary policy side, because I think there is a big conflict in terms of what they're trying to do versus financial stability. So I'll stop there.
Franklin, thank you so much. Given the time, we've got half an hour left. I suggest we go straight in to a discussion with some questions maybe from the audience that the panel can then pick off. While you're thinking of your questions, there should be a microphone loitering. It's MISA with microphone loitering. So if you start putting your hands up now, we shall come to you. One theme that struck me from all three presentations, it came out in slightly different hues, but is this stock flow inconsistency that we find ourselves, this paradox of policy, whereby we want to stimulate the new, the flow, while still being encumbered by the stock problems of the past. And there's an inherent contradiction there, it strikes me, that as long as that overhang be it on the balance sheet of the banks or of the households or of the companies, is still there. There are limits to how much stimulus of the new will be effective. I think that came through from all three presentations. So to questions now from the audience on anything that's been said. It's the one up here.
Hi. My name is Jaap Bos, Maastricht University. So about higher equity ratios and higher equity levels. The thing that always bedazzles me is what we should really expect from that. So if the market requires a relatively high return on equity from these banks, then if we only target the liability side of the balance sheet, which is what has happened, I think, in most countries, and just raise equity levels, in order to actually achieve that return on equity for shareholders, I'm not convinced that banks will become safer, because they will have to just take even more risk in order to realize then that return. So in none of your talks has this actually played a role. Does that mean that you think that the market will adjust and simply require a lower return on equity for these banks? Or does this think that you implicitly assume that we should also then, that we can ensure that there's less risk-taking on the asset side?
Martin, you have first go at that. There's a microphone just in front of you.
The problem with obviously I've been engaged in many discussions on this point, particularly when we were in the Independent Commission on Banking. And the problem you have in making this argument is that inherently you're saying that the market, it consists of a bunch of complete fools. And now, if that is true, that's what I was in many missions. I mean, essentially they're saying that they want a return on equity irrespective of the risk. They simply don't give a damn about the risk. And that violates basically every normal principle we have in how people make investment decisions. Helene discussed that. Now, one doesn't have to assume that they optimize very cleverly, but they should have some notion, and it's pretty easy to show, David Miles has shown this very clearly, of the relationship, even on the simplest possible assumptions, between the return on equity and the riskiness of those returns. It's pretty obvious. You're essentially assuming that they're risk invariant. Well, my answer to the investors is when they said that. Well, if you're that stupid and you're running the most important financial institutions in the world, obviously they should be run by the state. It's self-evident, because we can't possibly seriously allow people who are completely uninterested in the riskiness of their investments to determine the functioning of the most important financial institutions in the country. Now, they didn't like that very much. So, so basically, I think it's nonsense. I do think it is the case that if the financial institutions were deemed to be much better capable of coping with risk, with adverse circumstances, that they would accept substantially lower returns. I mean, the way I put in, and this is the last point I make on that, is that we've got a world in which the real interest rate is on safe securities. Franklin will argue that's distorted. Well, I won't go into that question now, but it's close to 0%, real, and we're told seriously that the only real return that investors in banks will take, however they're run, is 15%. There's something wrong with that.
Yes, so that's exactly the main answer to the question. I would just give a footnote to the answer. But there's another way. So if you really insist on having higher return on equity to investors, another way is simply to compress also the compensation package of the employees of a bank. In 2007, if you were doing a very caricatural little back-of-the-envelope calculation, which would have been to say, take Goldman Sachs, okay, return on equity, I don't know, 20%, 25% in the heydays, and then just plug in, instead of a compensation package of Goldman Sachs people there, the average compensation in the banking sector, okay, just as a back of the envelope. What would have been the return on equity? It was something in the order of 50 to 60%. Amazing.
So let me just say, Helene had put the book by Marty and Helwig, and I guess called The Bank Has No Clothes or something like that. So they go through a very nice menu of arguments against these standard ones about return on equity and Modigliani Miller and so forth.
And interestingly, it's almost the only two industries that actually focus on return on equity are interestingly banking and commercial real estate. Most of the industries focus elsewhere for reasons that I think the three panelists have pointed out very clearly. At the top there.
Should note that they are Siamese twins.
Yeah, they are.
They destroy each other regularly.
Peter Zweifel, University of Zurich. Repeatedly, I have read in The Economist that they advocate a new target, 10% nominal GDP growth. I'm shocked. Because without further qualification, that can be 10% inflation and zero real change in the GDP. I would like to have your opinion on this. You know, we think, are they playing the Phillips curve again, which has been proved by several, like Lucas, like Phelps, to be vertical pretty soon? Is that all lost now on the policymakers? I would appreciate to have your opinion. Thank you.
It's a slightly broader question, but I think Martin's the man to answer it.
No, I think Franklin is from his discussion. I'm afraid I missed the very first part, so I don't know who it was that you said had recommended a 10% nominal GDP target. You have recommended it. No. So who's recommended it? I don't know anyone who's recommended it. I certainly haven't read all the literature. I've read lots on nominal GDP targeting. I'm not aware of anyone who's recommended it should be 10% a year who is taken seriously, but maybe I'm wrong.
I mean, I subscribe to The Economist 3 times now within 1 month. The leader says 10% nominal GDP growth. I'm sorry. Am I the only one who reads that paper? I don't read The Economist, and I certainly don't regard it as a serious source of an economic advice. God, I feel comfortable now. So I thought you were talking about a serious economist. No. I think you're raising two completely... Well, let's forget the 10% target, okay? Because I think that's a red herring. I don't want to get into all of this. There is lots of discussion of whether a nominal GDP target would be more effective in terms of expectations in the current environment, and whether the failure to achieve a certain growth of nominal GDP indicates a failure of monetary policy or not. I think these are very interesting questions of what monetary policy should be aiming at in current circumstances. Franklin, in a way, is the person who raised that most profoundly, because I very carefully steered away from monetary policy questions. But I think the premise of your question is that if you're dealing with fiat money type policy, so we're not talking about the gold standard, the premise of your question is that the optimal policy at all times, which the Bundesbank would agree with you completely on, is to target a certain pace for the price level and let the real economy do what it wants. The assumption, therefore, is A, there are either no cycles or they're not important. There's nothing we can do about policy. I don't take the view that the sort of conditions we're in now, which are those, in my view, of a depression environment, are the sort of conditions in which that set of positions holds. So your position is, as it were, very broadly, Keynesian economics is never true, under any circumstances, should be ignored, or my position will be it is sometimes true, and we are actually in those circumstances. That's the issue. I don't think that's the conceptual question, to me anyway. So the Phillips curve is not vertical in the short run, or in the short run here could be a decade or more, and I think that's consistent with what we're seeing, but that's a very, very good debate to have. Forget about the 10% nominal GDP targeting. That's a bunch of cranks.
On which note, Richard Davis from The Economist has just walked in the room, actually, so we can...
I just thought I'd stare at
Helene or Franklin, anything to add on that? If not, with a question...
Our next Bank of England governor is keen on nominal GDP, I believe.
No comment. The question here.
Hi, I'm Margarita Rubio from the University of Nottingham. My question is about the interaction between macroprudential policies and monetary policy. So I would like to know if you see, or if you can develop on what would be the potential conflicts between the goals of monetary policy and macroprudential policies. And if you, also the second part of the question is if you think that a central bank responding to asset prices would be also a macroprudential policy by itself, and we wouldn't need two sets of policies, macroprudential and monetary policy. And the third question related to the issue is if you think in a monetary union, which is heterogeneous in housing markets, it would be a problem to have a unique macroprudential policy, or it would be better to let each country to have its own macroprudential policy. Thank you.
Let's start with Helene on any of those three.
Yes, so these are very kind of deep questions. So sure, there can be conflicts between monetary policy and macroprudential policy. So you can think of a situation in which monetary policy stance should be very loose, but at the same time there are some dangerous developments in real estate markets, for example. And so this would point out towards some kind of potentially increase in or tightening in the interest rate in order to increase the cost of funding, potentially, but you don't want to do that because of monetary policy loosening. So there could be, tensions like that. So usually then the answer to this type of tension could be there are other tools to use. So for example, loan-to-value ratios, debt-to-income ratios. So in general, what are the standards in lending in the housing market, taking away all kinds of subsidies that maybe are distorting the housing market and are increasing the likelihood of bubbles. So there are lots of potential additional instruments that can be used in order to have an effect on asset market, in particular real estate market, without maybe using the interest rate, which would be the monetary policy instrument. On the other hand, you could say, to have a more robust approach, maybe, the interest rate should also be used a little bit with a view of macroprudential policy. That's another position that one could take. If you think of how the credit is created by the banking system, maybe indeed moving a little bit the interest rate at the margin would actually decrease the likelihood of credit bubbles. And that would be a position that someone like Yoon Shin, for example, would push. So depending on what you think there, you can see either a potential for massive conflict, or you think you have enough instrument to meet the two targets. So it's an interesting debate to have. And within the euro area, obviously it is a very important issue, and there I think a lot more care should be taken when we think about cross-border credit flows within the euro area. And macroprudential policy has totally failed in the build-up to spot the massive gross and net claims of, let's say, German banks, French banks towards Ireland, towards Spain, which have massively contributed to the inflating of the bubbles in Ireland and Spain. So this is something that we failed to spot, and I think that should be definitely at the center of policy prescriptions looking forward.
Franklin.
I think that the questions you raise are very important ones. I think that the first problem is it's very difficult to spot bubbles, particularly in property, but also in stocks, obviously. If you look, we talked today about, those crazy bankers in Spain who were lending against property and so forth. But if you look across Europe, there are many other places where property prices basically went up similar amounts, which haven't had a huge bust. So the UK has had some of a bust, but not too much relative to Spain, or let alone Ireland. If you look at Sweden, Sweden also has about the same rate rise in property prices as Spain, but at least if you look year on year, it hasn't had a bust very much at all. Now, they keep debating in the Riksbank policy setting committee whether they should raise interest rates to prick the bubble, or whether they should just let it run. And I think it is very difficult to make that decision. And that's one of the big problems that macroprudential faces. My own view is that the evidence from Asia, where they've tried some of these things, is that things like restrictions on loan-to-value ratios and so forth work in the short run, but people fairly soon figure a way around those kinds of regulations. So in Korea, for example, they've had restrictions in certain areas when the growth rate of property prices gets above a certain level. Another interesting comparison in the Eurozone is if you compare France and Germany. Both have the same interest rates, and yet property prices in France went up over the last decade much more, about 150%, whereas in Germany they were very much flat. And the industrial structures are not that different. Things are not that different in both those countries, and yet we see these massive differences. And I think this is one of the problems that the Eurozone is going to face. How do you deal with these very divergent property markets and the problems that they cause? And macroprudential can do some things, but I don't think it's a silver bullet in the way that many politicians, for example, argue.
Martin?
I agree with basically everything that has been said. Indeed, I tried, very briefly I know, to indicate many aspects, some aspects of my skepticism about how well this will work. And I'll just make 2 points. The first is, I'm personally pretty convinced that from an intellectual and institutional point of view, it makes more sense, because the overlap is so profound and the interactions are so profound for these things to be decided by one committee. I was given an example, which Andy can question, that when the funding for lending program, which is clearly has monetary policy implications, was developed, the people in the MPC discovered this really very much at the very last minute and had no input into it. That just sort of seems to me ridiculous. Furthermore, it will concentrate power in the hands of those people who are in both committees, who, surprise, surprise, are the permanent officials of the Bank of England. Does that shock you? No, it's exactly what I would expect. Who, if I may say so, with the exception of the genius on my right, didn't do all that well in this crisis. So I think there are very profound problems about the organizational structure we've moved to, and I've written that. I think, I may be wrong, because I'm not an expert, that the Fed will continue with its current structure. But they've created, over on top of this, a completely new committee structure, which, I can't remember the name, you were the new Prudential Committee in the US.
FSOC.
What's it called?
Financial Stability Oversight Council.
Yeah, which is going to, on which every institution you can imagine in America will be beneath, and it seems to me it's going to be chaos. So this is really difficult to run institutionally. And I know economists don't care about institutions, but you should. And it's going to, because it determines what people think about. And quite apart from economically. The second point I would make, I just sort of think, because it's a point I've made in columns. If you look back on what happened in the US, and I agree completely about the difficulty of spotting bubbles, let us suppose that in the early 2000s to late 2000s, before the crisis, in the US, just focus on the US, they'd followed Ned Gramlich's advice, and they'd done something about what was going on in the housing market. And we could imagine much higher capital requirements or big shifts in loan-to-value ratio, lots of things. And let's assume it had been effective. That is to say, it had really taken the steam out of the housing market and housing-related borrowing in the United States. That would clearly have made what was already, by any normal standards, an extremely weak recovery with very disappointing employment effects, even weaker. What do you expect monetary policy to have done? Well, the Fed might have said, we think the whole economy should be cooled down. We should not worry. I think that might be consistent with what we say. We shouldn't worry about the fact that we've got this miserable recovery, so we should just not have these. We followed John Taylor's advice with much higher interest rates. The economy would have stagnated for years after years, and I promise you, the chairman and all the governors would have been replaced. Period.
Thank you. So, question here.
Thank you. Luis Angeles from the University of Glasgow. And a commonly held assumption in this discussion is that we want to stimulate lending from the banking sector so that this would stimulate the economy. This was part of the talk of Mr. Haldane and Mr. Wolf as well. But as the data from Professor Rey showed, bank lending is very highly correlated with actually asset prices. So a lot of the lending seems to go into just speeding up real estate and other assets. And this wouldn't have, for example, a clear direct effect on economic activity. Perhaps an indirect second degree effect, but not directly because it doesn't build up more assets, just speed up the price of existing ones. So I just want to ask the opinion of the panel on this. I mean, is it really desirable to have bank lending starting off again, if this is just going to go into bidding up asset prices?
Franklin.
So I think the question you raise is a very good one, as to what exactly did cause the bubble is the basic question. And I think there was a huge expansion, for example, in the US in the amount of mortgages. So they went from about 6 trillion to 12 trillion. That seems to have come from other places to a large extent, that they were lending it out, but it had exactly the effect you were saying. It bid up the prices, particularly in certain areas, and that was what the problem was. So I think this idea of good versus bad lending is a very important one. There's a very nice paper by Giovanni Della Riccia and co-authors at the IMF from last year, which looks at booms in credit. And about a third of them end in financial crises. And then of the rest, quite a few actually are good booms in the sense they lead to financial deepening and benefit the economy, and they go into good assets, into factories and businesses and so on. But one of the interesting things is very difficult in real time to figure out which kind of boom you're in. But if you want to read more about that distinction of the bidding up of prices and causing crisis versus financial deepening, I'd recommend that paper to you.
Yeah, briefly, so that goes also to in the discussion about whether the lack of lending is due to the supply credit crunch, or is it due to the demand side? And as was mentioned already once, I think this is the thing that empirically it's not super easy to disentangle. However, we do know indeed, I think, that badly capitalized banks do not lend, as Andy mentioned. And I think, so in the current situation, where bank capital has been in definite shortage, I think we can also learn a bit from cross-country experience in terms of observing credit crunches or not observing credit crunches. And here you can, for example, if you look at the experience of France, the credit growth has not been as bad as in the other surrounding economies. So what is it due to exactly are things that I think we can, by looking at the cross-country panel data, we could do, I think, a lot better. We could do, in terms of academic work, we could do a lot better there than what we have done so far. But I think, the fact that badly capitalized banks do not lend is something that is absolutely there.
Just make 2 points. I think this is an incredibly important question. The first, my reading of, which is obviously, I covered so many issues, so it's it's not deep. But my reading of the current state of the literature is that we really don't understand the link between credit and growth. Just focus on that one issue, that there is obviously some very interesting literature on, there is clearly a positive relationship up to some point to do with financial deepening and growth. There's no doubt about that. It seems to be pretty robust in the development literature. But once you get to the level of the high-income countries, and you compare cross-country between countries with very high credit ratios and low credit ratios, the link seems to be really collapses. And even if you didn't believe that, the literature, just the experience of the last 10, 15, 20 years should have convinced you of that. So I think your point is very profound. And this gets to the point, which seems to be the most worrying thing, is we really don't understand what the financial system does in the economy. They're not in any of the models. The banks, the central banks ran their models as if the financial system didn't exist. This is rather problematic for a central bank, isn't it? But it's because we really don't understand how this works, which really is the same thing as saying we really don't understand how a modern economy works. We've got a very good idea how a barter economy of the 14th century works. We haven't got beyond the Medici. I'm not joking. So you younger people here have a big challenge ahead of you. However, that all said, I think these are very important points because it gets to the question of what we do. I think, therefore, we should probably, and I did make this remark very briefly, I'm sure what I've said is very controversial, it's my view, is that we shouldn't worry about the aggregate balance sheet of our banking sector. Maybe we should worry about the money supply, but that's something I'm going to forget about for the moment, and the role of banks in that, because there are other ways of dealing with that problem. But there are clearly some sectors, above all small and medium enterprises, which clearly rely on banks for working capital, expansion. They don't have to. There are ways around it, but they're very difficult. It's clear the financial system is not now working in that area. It's quite a small part of the balance sheet, so let's focus government efforts on getting that to work. I am really not very persuaded, to put it mildly, I've written this in my last column, that the biggest aim of the government should be to get our housing mortgage finance thing going again, partly because I don't believe we're yet through the post-bubble collapse period. We can discuss at great length why I don't think that. And partly because leveraging up the housing stock doesn't seem to me to be the smartest idea we've ever had. So I would want more targeting, but I do understand the political and the economic problems of doing that. But I think the question you raise is fundamental. In this post-bust situation with macroprudential policy issues arising, where you don't want massively to expand what are in the UK already incredibly large balance sheet, how do you make sure the banking sector does actually some of the useful things, which are actually a very, very small part of the balance sheet? Any time a bank tells you they cannot shrink their balance sheet and expand their small and medium scale enterprise lending, ask them to show your balance sheet, their balance sheet, and laugh.
So time's always, but the last question, I think, is Richard.
I get one. Richard Portis, London Business School and CEPR. I've been trying to find common themes in what the speakers have said. First one is, yeah, we're in a very bad place, still. And it's a stock problem, not a flow problem. And how do we deal with that? I think both Martin and implicitly, at least, Franklin, said the banks should be writing down more. And the market should take over in that sense. The banks should be writing down more. They're not enough. And both Martin and Helene said, let's make them recapitalize more. And Martin actually said the government should support that recapitalization. Now, all that leads me to think that the market is not going, indeed, there's a lot of stuff out there, bad stuff, that should be written down. That's one way of bringing those, of doing the deleveraging, if you like. But the market's not going to provide that capital. So where do we go? Is the government actually going to have to step in to do that at some point or another? And might it lead us finally to the good bank, bad bank solution, which has been up and down, but seems to me maybe still the right way out of this.
responses on good banks and bad banks? Martin, you're looking poised.
Okay, God, why do I always jump into these things? My assumption is that they're alternatives. I assume you think of them as alternatives. The good bad bank policy is a way of ensuring that creditors get properly creamed for their, and so in other words, the UK decides to become Cyprus. I'm being a bit stuck, but that's essentially the, I'm quite attracted by the idea of the UK's deciding to become Cyprus, but one would have to reckon that it will create a few political and economic problems. And if the FPC recommended that, I don't expect the FPC to be around very much longer, namely about a week. So I think there are, and the reason for that is that there is no way that the authorities, broadly defined, even the bank, and even Mervyn, who's been the clearest on this, have prepared the public, the creditors, who are very important institutions, pension funds, insurance companies, so for the implications of the potential losses given the balance sheets of our banks, if we're serious about doing this in a big scale. But of course, that's related to what the question of how big the losses would then be. So my assumption for the moment is that something that drastic is A, not necessary and isn't feasible. I may be wrong on that, because it depends on the quality of the assets, which I think there's a big question about. I think Richard's right. But it's also the quality of the assets depends on what happens to the economy. So it links with the other side of what we're saying. But in the meantime, I do think they're undercapitalized. I suggest there are two ways of going about this, short of the good bad bank policy. One is for the government to say, this is the capital requirement. You put out a rights issue, we'll underwrite it. So we'll see what happens. The other possibility, which I'm very, very happy with, is simply to say, this is your target capital, and I'm sorry, no dividends, and we're going to watch your bonus policy like hawks until you've got there. Because I'm not convinced we need it today. We've got time, and most of our banks, not all, there is a big question about one, where I think the government would obviously have to put more capital in. We know what it is, surely. But most of the others have franchises, and in normal circumstances, they are and should be making money, and therefore they can accumulate capital if you want to do it, and that seems to me a less disruptive way of doing it. But this is a fundamental question, and the core of the question, which I don't think I'm clear about, is how bad are their assets? And under what circumstance? And of course, the person who really knows that among this group is Andy, and I suspect he's going to tell us.
It's the right assumption, yeah. Helene and Franklin, any last words from you?
So I think it gets back to the point that Martin was making earlier, which is how much more a house price is going to fall. And I think that's kind of the key issue here, because if the recession keeps on going and gets worse and all those problems, it may well be that house prices start going down. I mean, I find it astonishing how high house prices are. I come here every time and just I'm amazed at how they've stayed where they are. And that if those do go down significantly, then the bad bank, good bank solution may be a good one. But I agree completely with Martin in terms of they should stop payouts and they should limit bonuses to get the capital where it should be.
Listen, time is up. That's been an incredibly stimulating session. I hope Martin is wrong and that the FPC does last longer than a week. Currently, we're day 3 as a statutory body, actually, so lasting less than a fortnight would be quite an achievement. What this morning has thrown up is a whole heap of huge, huge analytical questions that will, and I hope do, are taken up by the audience, those in the academic community. I mean, I think macroprudential policy today is, if I was being charitable, roughly where monetary policy was in the 1940s in terms of theory, in terms of empirics, in terms of case law. And that does mean the FPC, the bank, central banks all over the world are going to need a whole load of help, as they did in the 40s and 50s and 60s and 70s, in putting macroprudential policy on a sounder footing conceptually, empirically, and that will need your help. So if you've taken away one or two big issues unresolved from this morning, and you feel the desire to work them up, that would be absolutely terrific. In the meantime, let me thank you all for coming along and asking such stimulating questions, and please join me in thanking the three speakers for tremendously entertaining and enlightening contributions. Martin, Helene, thank you.